viewers for tuning into this conversation with Devina Mehra. It's an apt day to have because it's the start of the week, which promises to be an eventful week. Whether the markets have that kind of a move or no remains to be seen. Devina, thank you so much for being with us on this show, and I really appreciate you taking the time out.
Thanks, Neeraj. Good to be here.
Thank you. Will it be the same feeling that market participants would evoke at the at the end of the week, if you will? I know you don't talk so short term, but I'm just trying to understand. There's a union budget, there's a Fed meet, and there's been considerable volatility in the markets in the last few days.
Yeah, I think it's gone a little beyond what the general budget volatility would have been, because there was this other big event of that report on the Adani Group. I think that was more of a trigger for the volatility than just the budget alone. So, and as you said, that I don't look at things from a 1 week perspective. From a longer term perspective, I remain positive on equities globally, and on top of that, India also looks like continuing its outperforming streak, because which came out of after a long period of underperformance relative to its own history as well as relative to global markets. So when that tide turned, and 2021 was the first year when India outperformed that out of a list of 42 indices, it was number 13, which proved to be lucky. So I was quite clear that that would continue. 2022, it was number 10. It's still down in dollar terms because only about 5 or 6 markets were in the green, but way better than the globe. I mean, India was down, I think, 4.7% on the average. Markets were down 18.5 or so. S&P was down about a similar amount, and Nasdaq, of course, did far worse than that. So that outperformance streak looks set to continue. And as far as asset markets, global assets markets generally are concerned, 2022 was a disastrous year, and I don't say this lightly. I'm saying that even if you take a century or more's perspective, it was a particularly bad year. So if you look at the bond markets, US bond markets records, or at least reconstructed records, go back about 230 years, and this was the worst year ever. If you look at bonds and stocks together being down, it happened once in 1931 during the Great Depression, once in 1941 during the Second World War, and then 1969 and 2022. So it was such an outlier year. So when things are, and not just the US, I mean, if we did the cross table of assets and geographies, and everything was down around the globe, all regional indices, all kinds of debt, everything was down. Only 2 positives were, even within commodities, the precious metals had a boom and bust, industrial metals also had a boom and bust. So net for the year, you were not up. Only things which were up were energy and a few agri commodities, and that was it. So it was, once that kind of year happens, you don't expect it to repeat, because that kind of thing doesn't repeat often. Of course, improbable doesn't mean impossible, but the likelihood is that 2023 will be an up year, and that India will outperform. So I remain positive on equities. Of course, you should have an asset allocation. That I always say that even if you are young, don't put 100% in equity. But having said that, it's a fine year. As far as this recent volatility is concerned, as with all such things, in the short term, the reaction is always overdone. So if you look at the Russia-Ukraine war, for example, in one day, India's markets fell 5%. And at that day itself, I had said that this will not last. 6 months later, you will forget there is a war on, except for things which are directly impacted. It's certain, if oil is impacted or certain chemicals are impacted, that's a different thing. But in general, it will no longer be an overhang on any global markets, India included, except the markets which are directly impacted. So that even in this case, not just the Adani Group, but also banks which have no exposure also to that group fell. So everything fell. So that kind of reaction in the short term is always overdone, and I don't see any great risk, at least in the short term, on this front.
Interesting. So, Devina, would you reckon that, because banks would be such a large portion of our index as well, and market sentiment too, and they have been beaten down, whether you call it ahead of the budget because of Adani or a combination of both. Do these valuations make you feel comfortable about the banking space?
The banking space is something that I generally don't like. So from the time we started our PMS in 2020, we had negligible weight to banks, which was actually a risky strategy given that, as you said, that they are the largest weight in the index. But that proved to be correct because in 2020, that was the only sector that was in the negative. In 2021, banks went up, but only half as much as the market. I think Nifty was up 22%, Bank Nifty was up 11% or something. So middle of 2022, we changed our stance and we went to about market weight, which with price action has become about somewhat overweight. So that's where we are. But so I mean, after a long period, not just the price performance of the stocks, but also in terms of fundamentals, things were changing for banks. The NPA cycle was largely behind them. Credit growth after a long time was doing well, and also that as interest rates go up, at least in the short term, banking margins expand because on the lending side, you reprice your assets basically to the wherever you have lent out money, the interest rates go up immediately. But the deposits, they get repriced only when they get rolled over. So that margin expansion also happens. So fundamentally also things are looking better. So that's why we are where we are in banks. But I am always, as I say, a little scared investor in banks, because in banks you never know where the negative surprises are hiding. Having been a banker, you know that, and from the outside, it is very hard to know where it's hiding. But having said that, it's like banks, it is about as good a time as I can remember for the banking sector.
Got it. Okay, since we've taken a lot of time, I won't extend this interview too much, Devina. I understand you have limited time at hand, but I have two more questions if you allow me, if you have the time.
Yeah, sure.
Okay.
I'm not so concerned with time.
Perfect. The third one is, a lot of people would have construed, and I'm happy you started off the conversation saying that you are kind of constructive and the reactions were overdone. A lot of people would have construed that if indeed what happened last week that sentiment were to stay, and if there is some tinkering on taxes, etc., in the budget, and I'm not asking you to second guess that, but what I'm asking you is, if that sentiment doesn't prevail that way, and if the FPO goes through, it's a hypothesis, and if the government doesn't do any tinkering with either the glide path on the fisc side, or there is no devil in the detail with regards to taxation or otherwise, would you reckon that the sentiment turns? And if the Fed also doesn't sound hawkish, let's say, then do you reckon the sentiment around Indian markets turns positive immediately? I know there's too many ifs here, but there are too many events bunched up.
So let me tell you two things. One, I do not make a forecast of on what's going to happen end of the week. In fact, I'd never even make a forecast on what is going to happen end of the year. I've never given a Nifty forecast, because that is something that Daniel Kahneman calls objective ignorance. It's something you cannot know. So there is no point, speculating on that. Number one. Number two, you talked of sentiment. So I mean, let me just give your viewers something interesting on sentiment, which is that sentiment is always a contraindicator. So all studies around the world, and not just the US, but Portugal, Brazil, every country where there has been a study, it has shown the same thing, that when sentiment is very good, very buoyant, everybody is feeling good, the next period returns are below average. When sentiment is poor, people think there is risk, there is volatility, the next period returns are above normal. So this is something I try to tell people in 2021 when all these NASDAQ ETFs were coming, that just because NASDAQ has performed so well in the past 3 years, this recency bias, it doesn't mean it's going to perform well forever. And then when NASDAQ fell 40%, those same people came, said, should we sell now? I said that's like compounding a bad decision. So don't get caught up with what the market sentiment is. Don't try to either second guess or try to gather information on what everyone is doing. That is very poor use of time. And this is like sentiment being a contraindicator is one thing. The other thing also, which is also very interesting, is that you hear of both the wisdom of crowds and the madness of crowds. So where does the what is the truth of it. So the thing is this, that when you pool in independent opinions, then the quality of the average is better than that of the individual opinion. So if you ask somebody, if you ask 200 people to guess how many marbles are there in a bowl, the average is going to be better than 1% or 2% guessing it. But when you discuss and talk and get influenced by everyone's decision, like let's say a company is trying to decide whether or not to go take up a certain course of action. So then it becomes like who speaks first, who speaks more forcefully. People who haven't made up their mind will go with the majority, and at the end of it, the quality of decision goes down, but the confidence in the decision goes up. So it's really a deadly combination. So do not waste your time finding out kaun kya kar raha hai, what my friends are doing, what this institution is doing or that institution is doing. That's only going to bring down the quality of your decision. So that's like on the sentiment part, those are my two inputs.
Just last two questions. So there is an investor who's listening to us right now, Devina. She's sitting in Gwalior or Rawalpindi or Chennai or wherever, and is trying to guess or trying to understand whether Devina Mehra is taking advantage of the current extreme volatility, which Devina Mehra herself said maybe to an extent was overdone too. What is Devina Mehra's answer?
Yeah. So we were already almost fully invested, so there wasn't like much room to reinvest more. So it hasn't changed. I mean, we were anyway just done a rebalance because we do a rebalance every quarter. So January we had already done a rebalance and we made whatever tweaks we wanted to. So that I mean, there's no recent changes as in the last 4 days. In January, I mean, I spoke about getting into banking middle of the last year. This quarter, the significant change would have been that pharma, which we hardly had any exposure to. We increased some exposure to pharma. I think a little bit to auto components also. So that would be the recent changes.
Got it. Devina Mehra, my final question around flows. A lot of people get, maybe rightly so, but a lot of people currently evoke the response of how the EM dedicated funds or global funds would be taking money out of markets like India, Indonesia, etc., and moving to China, which explains the kind of flows in India versus some of the other markets, so on and so forth. That narrative is fairly popular here. Do you have any thoughts out here?
So again, I would say that don't spend your time doing this on where the money is going or will go. And I speak as someone who was there right at the beginning when the FII window opened, so to say, 1993 budget. So exactly 30 years ago, Dr. Manmohan Singh's budget, where the FII, the market was open to FIIs, and that was a trigger for me to resign and join and start First Global. So that was the trigger. But having said that, we actually tracked it very closely for several years, that FII flows and markets, and then we found there was absolutely no correlation. And even on a broader level, 93, 94 is when the FII flow started coming in, and 94 to 2003 is a 9-year period in which the market had zero return. I think that would be the only 9-year period in the Sensex history. So this huge flow of money came in, but the markets had gone up before the money came in, and there was no domestic mutual fund industry to speak of at that time, and yet that money did not move the market. So don't spend your time doing that. I mean, once again, I would say that whether what your friends are doing or what FIIs are doing is not of much relevance. So, don't try to think that how the global asset allocators are putting money here or putting money there.
Okay. Well, viewers, a very short conversation with Devina Mehra, but always enlightening and always gets one or two really good points to tinker over. So ponder over that. And Devina, take a moment to thank you for joining us today and giving us your thoughts. Much, much appreciated.
Thanks, Neeraj.
Yeah. And viewers, thanks for tuning in.